Okay, so let's dig into it. Okay, some of this will be a little bit of, all right. What is the goal? As a reminder, what is the goal with every encounter? Collect data and have a real estate conversation. Every encounter I have, I can't go up and meet someone, say, hey, my name is Mike, here's my phone, give me your name and phone number, right? I gotta have a real estate conversation with them first. I gotta get them to the point where they want to learn more about what I do. They want to learn more about real estate. They want to learn more about what we do as real estate wealth managers. So we have the real estate conversation, and then to your guys' point, or I should say, the more real estate conversations you have, the more money you will make. It's a guarantee. We always joke here that, for a lot of agents, especially a lot of new agents, they get their real estate license and they think it's just an open sign that goes around their neck. And the deals are going to come. It really just comes down to having real estate conversations. Again, the more real estate conversations you have, I guarantee you the more money you're going to make. As a reminder, we say this all the time. People don't want to talk to a realtor. Okay, no one wants to talk to an agent. How many did the commissioner say we had active licensees? Was it 98,000?
We had all that in here last week. It was
so there's 90 to 100,000 licensed, 90 to 100,000 licensed real estate agents in the state of Arizona. Nobody wants to talk to us, but everybody wants to talk real estate. And that, again, as a reminder, is why it is so important for us to really focus on being a real estate wealth manager, because we can have at a deeper level, we can have real estate conversations, deeper real estate conversations with people than other agents, because other agents are just having conversations about being an agent and what they do. So that's our little bit of reminder. So what I wanted to do, again, you need to ask two questions every encounter. What's on people's minds right now? When they think about real estate, they think about buying a home, they think about selling a home, what is on their minds? And typically, for COVID, we knew it was COVID. It's been inventory, certain times a year, certain things are on people's minds. We're coming up on that season right now. What's really on people's minds right now is I got to figure out I want to move to a different school district, and how am I going to get there? And so know what's on people's minds. So if I'm having a conversation with someone who's got some young kids, that might be where I drive a real estate conversation. Okay, if you don't know what's on their minds, what should be on their minds, right? And create that. What should be on people's minds right now? And for me, what should be on people's minds right now, if it's not on their minds right now, our interest rates are going up. And you better jump into the game now. Because if you wait 60, 90 to 120 days, you are leaving borrowing power on the table. So with that, I thought what Justin and I would do is talk about having real estate conversations based on lending. And some of the things that are on people's minds, when it comes down to mortgages, when it comes down to rates and things like that, so that we and we don't need to be experts. There's a lot of programs up here where our goal is not to be an expert. I'm not an expert on most of these programs up here, but I want to be able to have an intelligent conversation with people about some of these programs. Because if somebody is saying, hey, this is my situation, I'm an independent contractor or self-employed or whatever the case is, I can have a little bit deeper of a conversation with them about available programs, what these programs look like. I never get into the nitty-gritty with them because that's Justin's job. And if we start talking about mortgages, I want to get people to the point where now what they're wanting to do is talk to Justin's team and get that, maybe make that introduction, via text and so forth. So I have to turn this down. Jeez. So Justin, why don't you take it away, and let's just kind of do some highlights about what some of these programs are and what we need to know when trying to create deeper conversations.
Yeah. So conventional loans, that's your prime product, right? 3% down for first-time home buyers. 5% down for somebody that owns another home or has owned another home in the last 3 years. Conventional loans, big difference between conventional FHA is if you're putting down a lower down payment, mortgage insurance will fall off. FHA mortgage insurance is for life. Okay. Lower closing costs too with conventional loans over FHA. Obviously, FHA is having issues getting under contract these days as well.
Well, on conventionals, how many people out, not us, but how many consumers out there know what Fannie Mae and Freddie Mac is?
They really don't, and so we really don't talk about that to them unless they ask us questions, because we try to keep it basic. There's a lot of information that we go over. We don't want to overwhelm them with information and confuse them. Now, we'll tell them differences if we have, let's say, appraisal waiver on one and we didn't get an appraisal waiver on the other. We'll kind of explain why we're switching them, because a lot of times there are pricing differences. It just depends on the day though. So what we'll do is we try to go with the best pricing first. If we don't have an appraisal waiver there, but we get an appraisal waiver somewhere else, we're going to switch them. But their guidelines typically run right in line, unless it's calculations on liabilities and stuff. I know that's a lot of information, but
Right.
They typically run pretty darn close to each other on everything as far as guidelines go.
Has anyone in here had a conversation with a client talking about financials and they say, yeah, I want to buy a home for $400,000. That's my budget. Or just whatever random number out there, right? Yeah, that's what everyone says, right? That is not what they mean. They have no idea what they're talking about, honestly. What do they really care about? Okay, monthly payments and what else? What they're gonna have to put down in order to, what kind of money they're gonna have to come out of pocket in order to close the deal. They think that they know what that $400,000 means, but they have no clue, because there's all these different types of programs out there that's going to affect what two things? Payment and money they're gonna have to come out of pocket with, right? So having just some even basic knowledge, not overloading them with Fannie Mae, Freddie Mac, and all the other different intricacies that go along with it, breaking it down, saying, hey, look, these are a handful of things that are going to affect your monthly payment and what comes out of your pocket. And from there, we need to have those conversations with Justin and his team. Go for it. Sorry.
Well, the other thing I've been telling people is they keep saying, oh, well, Zillow says it's this much a month.
That's what I was going to talk about. So people get their idea of what their payment is based on the principal and interest payment that Zillow's posting with a 20% down payment. So they come to us and they're like, oh, well, Zillow's telling me this. This is actually what it is. We got the taxes and insurance.
So, okay, so if you've been a home buyer before, but you haven't been a home buyer, you don't own a home, it's been a while.
3 years, you're a first time home buyer.
Okay.
Yeah.
It just resets.
Yep.
Okay.
So conventional products we like to use for people with higher end credit. It's 680 and above is typically what we put people in, unless they have a large down payment. FHA is a wonderful product for people with low to mid-grade credit. So when I'm saying low, we can go all the way down to 580 up to a 800, obviously, but we'll keep them in there typically until they hit 660. Then we start really crunching between conventional and FHA. We'll tell them the differences. But the nice thing about FHA is whether you have a 580 credit score or 800 credit score, you're getting the same mortgage insurance premium. Whereas conventional, you're graded on what your credit is. It can be extremely high if you have a lower credit. So that's why we tend to push them towards FHA. Also, they're more forgiving on the loan level pricing adjusters. That's what affects your interest rates, the adjustments in the interest rates. So if somebody has a 580 credit score, they're going to get a much better interest rate than if conventional even had for a 580 credit score, or even a 640 credit score. They're going to get a way better interest rate than what a conventional will offer at a 640 credit score. So,
Yeah, and so one of the conversations that I'll have with people is say, if we're going to talk about buying a home, say, conventional loan is the most ideal. You're probably going to get the best rates, the best option out there going conventional. However, it is based on credit. You know how much you by any chance know what your credit score is? Well, yeah, I know what my credit score is because I got my free credit report, whatever the case is. I go, well, you really know what your credit score is. You know the credit score that the lender is going to look at because what you're seeing oftentimes is not the same thing. Well, what are you talking about? You have that conversation with them. Well, you need to find out exactly what your credit score is. Boom. Let me introduce you to Justin.
Yep. Yeah, and on that point, you got a lot of people out there that are like, I don't want to buy for 9-10 months. Why don't we come back to this? We'd like to get them going now. So one, we can educate them on what it looks like. Two, it might press them to move a little bit earlier, but it also could give us time to get them in a better position to buy. Maybe they were only able to go FHA, but if with that period of time, maybe we can get them into a conventional with a good product if they do need to wait. FHA, 3.5% down. The reason why FHA's mortgage or cost is higher is they have an upfront mortgage insurance of 1.75% that gets financed back into the loan. So pretty expensive.
So yeah, so I have no money.
You have no money. Well,
I need some free money.
Well, I hope you're either a veteran.
That
we got down
ship
payment
is sailed,
assistance.
pal.
Yeah.
I'll be your co
Big thing about FHAs though, reasons why a lot of listing agents aren't accepting them, and you probably already know this, but they have a clause in there that states that they do not have to overpay for the home. So even if you put something in the contract that says that they're going to waive the appraisal, that trumps what your contract says. So they can get out of it easy, just like a VA loan too. Yes, sir.
For FHA, I was just talking to an individual on this yesterday, just to clarify. So if somebody currently has an FHA loan out in another state
Mhm.
that they did reside in
Uh-huh.
prior to moving here, can they get it qualified for another FHA?
Yes, sir.
loan here?
Has to be more than 100 miles away.
Okay.
Yep, and they absolutely can. So let's move down to VA. So on your point there, a lot of veterans don't know about VA loans. They think that they can only use this opportunity one time. That's not true. You can also have more than one VA loan out at a time. It just depends on how much eligibility we have. So let us play with those numbers. There's a calculation, there's a sheet for us to do for you. We can talk to them and we can figure out if VA is the way to go, or possibly we could refinance the current VA loan into a conventional loan. VA loans are wonderful. They traditionally have the lowest rates out there. They do have no mortgage insurance at 100% financing, but they may have a funding fee. So funding fees are pretty hefty. If you're doing a $2 million home at 3.6% for your funding fee, whew, that's a heck of a fee right there.
So I see this a lot. Because we obviously, we do a lot of work on base. And guys will go, oh yeah, well, I'm using, I got this other lender who's out of state because he specializes in VA loans.
Yeah.
He's a VA loan specialist, leaving people with the impression that they've gone through special certification and they know more than everybody else.
Well, it's just kind of goes along with USAA. We see insurance all day long, and USAA, you have to be a veteran to go there, but the amount of money that they charge individuals to do homeowners insurance or car insurance through them, it's out of this world. Sometimes we see it, 4 or 5 times the amount that we see on somebody else that's given better coverage. But it's the mind game that people are playing out there. There's tons of wonderful salesmen out there. We do a ton of VA at the office, because we have Luke out here, but it's incredible how many people come to us from Veterans United. It sounds great, right? You worked hard for that. You served our country, and they're making it sound like they're doing something special for them, but they're not. And typically they're charging them more because they know they got them. And that's the unfortunate part. And
so with the funding fee, and when I'm talking to an active military or a veteran, because they're like, oh yeah, VA, they just think VA is the way to go. No, low interest rate, 0 down, and so forth. And you have that conversation about the funding fee.
Yeah.
And I say to them, sometimes if you've got cash, even though you've got VA eligibility, sometimes a conventional loan is really the way to go.
Yeah, we found that with Kyle Dowd. He was putting down 25%. 25% is going to give you tremendous rates on conventional loans. You got 800 credit score. There's no reason to pay at that point when you're putting that much money down. You get relief on the funding fee, but it's still 1.4% of the loan amount. So we explained the difference, if you were to buy down the rate on a conventional 1.4%, because essentially that's what you're doing. You're spending the money. Here's what your rate would be, and it was tremendously better. So it's not always the best, but if you're looking to get in a home with 0 down, 100%. 100%. It's much better than down payment assistance programs. Yes.
When you say low rates, how much lower than conventional are the interest rates?
So it depends on the day. In a time like right now, I would say we're probably 0.7% better. So that's a significant difference, plus no mortgage insurance. So if I'm paying 3.6% for that, and I have no money, I'm doing it. Even on the financial side of things, I mean, you're gonna get your money back real quick in this market with the way things are going up. But yeah, the payments are cheap on a year.
So how do I avoid a funding fee?
Well, there's you either have to have been awarded a Purple Heart, or you have to have more than 10% disability.
But we're pretty convinced Ryan's got a black heart. Does that count?
But I don't have any military experience, so.
I love it. I love it.
All right, so let's talk about DPAs.
All right, DPAs. So DPAs, they change the rules all the time. Currently in the Valley, I think we have 4 different ones. Just your basic rules, okay? 640 credit score or above. They're going to give you money, but they also charge a lot of money on the back end. The interest, they're giving you the money, but they're giving you a higher interest rate so they can get their money back, okay? Something that a lot of lenders don't even know is you can own a home and get a DPA. You don't have to be a first-time home buyer. You can actually own a house and get a DPA to buy another house. So we use this tool a lot to get people into another home. Now, they can refinance it. We like them to make 6 payments. If they refinance it before 3 years, they're going to pay a prorated amount back into the refi. A lot of times we like to wait 12 months just so they can really gain some equity in the property. In the last 2 years, this has been incredible because we've been able to refinance people before a year, get rid of mortgage insurance, and they put nothing down,
So give us a little bit of the bullet points of DPAs and just, kind of how it works. Because for me with DPAs, depending on who I'm talking with, at the end of the day, DPA is not a great program. But if you don't have any money, I mean, you 100% don't have any money and you got a good credit score, then, DPA is better than renting for the rest of your life. But for me, down payment assistance programs is almost like the lost leader. It creates conversations. And then I'll let Justin and his team talk them out of the DPA and take a look at other programs. But people love the idea of, free money.
That's correct.
Yep.
So we love getting them in like this. And then once we get the clients in, we're going to ask them, do you have 401k? Do you have the ability to get a gift? We just ask that we search those up front. We just kind of feel it out. Nothing more than that. But then we start going through the programs. Now, when you're talking about DPAs, on average, now there's a lot of different programs, so their fees are different. But on average, typically you're talking about 1% more in cost rather than a standard loan, plus about $900. Okay, so we're talking a significant amount more in fees. And when we're talking about interest rates, we're talking more 1% to 1.5% higher on the fee, on the interest rate than a standard conventional loan. Okay, so significantly higher in the interest rate. Also, down payment assistance programs have more restrictions on debt to income ratios. So by having higher interest rates, lower DTI requirements, your buying power goes significantly down. Monthly payments go up quite a bit. So that's where we really get people, is because obviously the cash to close is a lot less because they're getting the money. But when you're talking about a monthly obligation that's significantly higher, that's how we get people to really think, where can I get these funds from? Can I get a gift? Can I take a loan from my 401k so I can pay myself back interest and get into another asset and spread my wealth. That's, I would say about 50% of the time we're able to flip them over. So DPAs are, just like Mike said, they're a great source to get somebody in the house that have no other options. And then we'll refinance them later on, but it definitely, they take a hit for getting that money. It's not free.
Yeah, and for me, again, I let these guys have those conversations with them. I just want to get people excited about the idea of free money.
Yeah.
You know, I'll go through some of the details, but again, I don't go into the nitty gritty. But if it creates a deeper real estate conversation, or I'm talking with someone, they say, oh, this would be great for my kids, or this would be great for my grandkids. You know, that's the whole goal. I think we kind of hammered Jumbo earlier.
Yeah.
So bank statement loans, let's get really creative now.
So bank statement loans is one that I'm not a huge fan of. And the reason why is because you're going through private money, you're trying to get money from that's not delegated. So we're not underwriting the file. So we don't get to manage the timelines of the underwriting. Now, the idea of the product is incredible. The interest rates are actually pretty good too. They do require 10% down. Unless you're getting a gift. If you're getting a full gift, you need to go 20% down. Minimum credit score, I believe, was a 680 the last time I looked, and I'm doing one right now. 24 months bank statements or 12-month bank statements. And basically what we're looking for is to see the income coming out, or the income coming in and the income going out, or the money going out. And the reason why we're doing these loans is because somebody didn't claim what they made on their tax returns as a self-employed borrower.
Anyone in here?
No. Trust me. It's creative accounting. You know, you don't want to pay taxes. But it's crazy how many different ways you can fill out tax returns and think you're claiming your income, but you're not. It's not your profession, right? You're relying on your CPA. So a lot of these cases, we get people with mid 700 credit scores, and they make good money through their business, but their CPA is a gangster,
Which is ours.
I have no idea what you're talking about.
And they're finding these cool loopholes, but we can't count the income. And so, you know, in a lot of those cases, we have to have very delicate conversations, but we'll go for a pre-approval prior to going out shopping through these bank statement loans.
So how about the interest rate for those?
They're actually pretty good. The one I'm working on right now is 4.5% on a bank statement loan, which is basically slightly higher than what we're offering. In most cases, outside of this strange market where interest rates are flying up, I would say the rates are typically 1.5% to 2% higher on those.
I'm not actually all that familiar with those cash flow loans, but tell us a little bit about that.
So cash flow loans, I'm not very familiar with, but typically we would call a bank statement loan a cash flow loan.
Okay.
Just because we call the self-employed worksheet a cash flow analysis worksheet. So I think it's just another creative way to call it a bank statement loan for self-employed individuals.
Okay. Reverse mortgages. So,
Reverse mortgages.
you know, when we're talking to people who are a little bit up there in age, I find when you talk with people, and I don't talk to a lot of them, but there's a lot of misconceptions about reverse mortgages, and they're a great product for certain people.
Absolutely, there was, there's been changes to reverse mortgages. 2019, a lot of regulation put on reverse mortgages, where lenders used to be able to charge almost 10% and make that money direct. So, I mean, that was an insane fee. But reverse mortgages need to be 62 years old to do them. You're going to want to have both of the borrowers. If there's a couple, you're going to want to have both of them there, or else if the one individual passes away, then the home would have to go. But there's a lot that goes into reverse mortgages. A lot of people are using them to buy homes right now. We can close them in 17 days. There's the last one that we did. You can basically, if you were able to sell a home, take away, let's just say $300,000, you could buy a $600,000 house, put the $300,000 down, not have a mortgage payment for the rest of your life and have a line of credit as the value of the home goes up. It's pretty cool.
We use it as an owner op.
It's primary residence only. Yes, unfortunately.
So in essence, I'm 63 years old, and I got $300,000 equity in my home, and I didn't, I'm not expecting a lot in Social Security. I can basically then that equity, and then as the equity goes up, I obviously get more equity, and then now I can start living off of that.
Correct.
It's not a great legacy plan for kids and the grandkids, but it's not why we work, right?
Yeah, and a lot of people think that your children and your grandchildren are going to lose the home. That's not the case. There's a calculation on what needs to be refinanced or paid off. There is those options. But typically the individuals that we're putting in reverse mortgages have other assets outside, or the families just doesn't care about the home. They just want to make sure mom and dad live a comfortable life that they worked hard for.
Can you carry more than one reverse mortgage at a time?
You cannot.
All right, so I want to talk about a minute or two on HELOCs, because I think for what we do as real estate wealth managers, home equity lines of credit, I think, are paramount. And I have this conversation with a lot of my clients, especially the guys out at Luke. They don't necessarily, they want to be able to jump on an opportunity if we present them with an opportunity, but they don't necessarily have that kind of cash. And so for every homeowner that I work with that's got quite a bit of equity, I tell them right away, get a HELOC so that you have it there.
Yeah. HELOCs are a wonderful tool, and I believe 100% in them, and I do the same thing. I have a HELOC on my house. I don't use it unless I need it, but the best part about a HELOC is you pay on the money when you borrow the money. You pay an annual fee, but it's like $50 typically. The interest rates are slightly higher. They are based on prime, so they're by variable rates. But you could do a HELOC. Some banks will go up to 90% loan to value. Actually, I've seen 95% combined loan to value on that. You can hold the HELOC there. It's a 10-year draw period, and then it becomes a 20-year fully amortized loan to pay off. But you get a credit card, you get a checkbook, you can write against your home equity line. First of all, much cheaper than a credit card interest rate, right? And you have a much larger line of credit typically. It's secured. That's why it's cheaper than a credit card. So typically, I would say right now your interest rates on home equities are running between 4.5% and 7%, just depending on what your credit worthiness is and how much you're hitting your combined loan to value.
And I also tell them if they're going to hang on to their house, through Reaganomics, and they've got a lot of equity, they're going to go buy something. Get the HELOC. It's easier to get a HELOC on a primary residence than it is on an investment property. So do it now so that you have it.
Correct. So that was going to be my next point is when you have something that pops up that you want to invest in, whether it's some crazy stock or you want to buy another house, it's so easy to get that cash to go do it right now. You're not having to wait. So get a home equity line of credit and have it sit there and be prepared for that investment. A couple of things. When GameStop happened in COVID, I threw a bunch of money out of my home equity line of credit and I made a ton. I could have lost it, but it was nice to just have that cash right there. I didn't have to pull it out of any of my stocks or anything like that. I was able to do it. Investment property, down payment right there, and then I'll pull it back from stocks or something. Yeah.
Yes, I have a couple questions. One is gonna be, that's gonna be completely independent of your monthly payment, so you're gonna pay it as a credit card or?
It's a separate mortgage statement that you're gonna receive every single month. Yes, it's completely separate, but it is a second mortgage on the house. It holds a lien on the title of your home. And it will be a separate
So,
payment.
and you pay for what you spend, right?
Correct. Just like a credit card. So if you borrowed $10,000, you're gonna pay, it's interest only to start for the first 10 years. So whatever you're borrowing on, it's interest only. You just need to pay extra if you want. But if you borrow $10,000, you're gonna pay 4% on that $10,000, what the monthly calculation is.
And so this is the number one for me of all of these things, the number one conversation piece for me. Because there's so many things that go also higher interest rate. And typically a HELOC is not a long-term solution if you're gonna go buy another property. But you take a look at what's the monthly cash flow. Maybe it is. And so this just becomes a deeper conversation. And I talk a lot with, because in our market, everybody's sitting on equity right now. And everybody wants to invest. Now with interest rates going up, a lot of people don't want to do a cash out refinance because they don't want to lose their interest rate. So it's a great conversation piece.
Absolutely.
And that is gonna affect your power of buying, you know, if you have like a HELOC or that's, let's say that I have zero,
If you don't have anything borrowed on it, so we're a direct lender, we're not gonna add to those guidelines, but there is banks out there that say you have to hit for 1% of whatever the full amount of that HELOC is against their debt to income ratio. But we do not. If you borrow zero against it, we're counting it as zero on your monthly obligations. But if you do have money borrowed, absolutely, it will count against your monthly obligations in buying something else. Yes?
Is there a waiting period after you purchase a home? Like, obviously, you need equity, but for instance, I own a home buyer's home, which I'm willing to buy it, we're already coming in on equity.
So there's no waiting period to get a home equity line of credit. Typically, you just need to have that equity there to get that home equity line of credit. Yeah.
And can you give a scenario as to why, like, I know you might kind of mentioned doing a cash out, you lose your interest rate if you do a cash out refi compared to a HELOC, but in general, like, what's the big deciding factor on that? Is it just interest rate? Is it?
So if I'm advising you, I would get a home equity line of credit if you have more than 20% equity in your property all day long, just to have it sit there for security purposes. So in our business, you know, it's not going to be 2019, 20, 21 all the time. There's going to be times where you may need to borrow from Peter to pay Paul, right?
Yeah.
So that's why I like to have it there. But so I hear what you're saying. So let's say you had $20,000 on credit cards and you currently have 2.99 interest rate, but to do a cash out refi, it's a 4.25. Well, it's only $20,000. So I'm going to tell you, go get a home equity line of credit, pay those off with that rather than using a primary mortgage. Because if we do a primary mortgage, we're talking about $5,000 in closing costs, right? A home equity line of credit, you're talking about $500 in closing costs. And because it's only $20,000, it'll be easy to pay that off. Now, if we're talking $50,000, $80,000, then we're going to talk about probably doing it in a primary mortgage, because that's a big amount of money to have on a variable rate, right? So if we're talking about rates going up 3%, which would be unlikely, but it could happen right now, but that could be dramatic for your monthly payment. Yes, sir.
Do you know if the tax benefits apply to HELOCs like we do primary mortgage?
Yeah, they absolutely do, but I mean, yeah, you still get to deduct the
Interest.
yeah.
It depends on how you use those funds though. I mean, I don't know if you could deduct it as an interest payment against your taxes if you're paying off like credit card debt or buying a new, you know.
I'm not a CPA, but it does say is it mortgage, it's the IRS is pretty cut and dry. It says mortgage interest. So to me, I'm putting it in there if I'm a CPA.
Well, and every time you take a HELOC, it's always for home improvement,
Correct.
There you go.
always.
Nailed it.
And you get miles from Southwest.
Yeah. So to your question, Mia, it depends on what the purpose is.
I just,
If I'm dealing with someone that's got $100,000 worth of equity and they're like, we're going out and buying properties, we know it. We're gonna do a cash out refinance. If somebody's, not sure yet and they're not quite there yet, let's do the HELOC so that you're not losing your current interest rate. And then if something pops up, now you're just ready to jump. I mean, it's that simple, ready to go.
And that's the beauty of it. It's so easy to get the money. That's why I hold it. It really is. If I see some type of investment come up that I can't miss. I've missed them in the past and I don't want to miss them anymore. I want to have those funds available for those opportunities to make extra money, right?
and do you have to do the HELOC with your Or
You do not.
Just do it with anybody.
You can do it with anybody, but I mean, call me and I'll tell you where I'm seeing the best interest rates for those types of products. But I can do a HELOC only if I'm closing a primary mortgage at the same time. I cannot do a HELOC on their own. Other than that, I'm going to tell you where to get by this one.
So we got about 10 minutes to cover 3 slides, so,
Okay.
so it's good. So we're having conversations right now. What's on people's minds right now? Are interest rates.
Yeah, yeah.
How do we have a deeper conversation about interest rates?
Well, I mean, interest rates are an easy conversation to have. I mean, just to get really deep into interest rates, you can talk about inflation. So, a lot of people think that.
Let's start with the easy stuff. Like, what are some upfront things that are just like, okay, this is what affects your interest rate, and here's how you can make that.
Credit score.
Okay?
Credit score affects your interest rate.
Uh-huh.
And easy things to make it better, get your revolving accounts down below 20%, 10%. You can get them down there, you're gonna get your credit score up, and then you're gonna have a better interest rate.
They have an analyzer over there at Fairway. Once they plug it in there, if they're at 670 and they need to be at that 680 in order to cross that threshold from FHA over to conventional, it's a simple phone call. They run credit. They say, hey, look, this credit card's here, needs to be there. This auto loan's here, needs to be there. You need to wait 6 months before this falls off, whatever.
We'll tell you how much it takes and how long it's gonna take to get you there. And if somebody doesn't want to do it, no problem. Let's just take you another route, but this is what it would cost you.
I heard Ryan having that conversation with a client the other day where he was like, "I got this guy over there."
Yeah.
They have this tool, it's amazing. You're gonna talk to them, they're gonna tell you exactly what to do.
I mean, honestly, we're not credit experts, but we're right there. We've done a lot of self-taught training on it, and we've worked with the credit reporting agencies to teach us how to do it. So we do a lot of their work ourselves, just because there's nobody else we trust to do it. And that's the thing is, we've given them over to these credit companies and they drop the ball all the time.
So people are asking me, what, okay, everybody knows interest rates are going up, but why are interest rates going up?
Well, inflation. So inflation, we just heard yesterday, is 7.5%. This is insane. We need it to be about 2.2%. So during COVID and this last period of time, there was about $6 trillion in circulation in the US. There's $9 trillion in circulation in the US. This is a crazy amount of money, $3 trillion that's out there. So there's a lot of money in people's hands. So the buying power is out there. So what we got to do is slow things down. With the economy, in order to speed things up, you lower interest rates. In order to slow things down, you raise interest rates. We have to slow down to bring the inflation down. We have to slow down fast. So we haven't even seen a Fed rate change yet. They should have done it a long time ago, but we're going to see it, and it's going to have an impact on interest rates dramatically. Here's the thing: 1990s rates were almost 20%. Okay, the last time the rates were below 4% from 2010 was World War II. We're going to have some times where rates are higher. We're going to be fine. We just got to keep our heads down and keep working. There's always going to be people buying, no matter what time it is.
And we got to keep people positive.
We do.
Okay, so yeah, so you didn't lock in. Now your interest rate's up there, or you should have bought 3 months ago. But how are your team keeping people positive about it? It's celebrating the fact, hey, you're still not paying 8%.
Yeah, waiting longer would be done.
You know what I like to say in our office is stay non-emotional about this. This is business. This is an uncontrollable factor. We still have to operate. People still have a goal to buy a home. So we're really not acknowledging the stress of it, except for, I mean, we are acknowledging it, but it's not something that we're having conversations all day long about it. We're telling people what the market's doing. We're preparing them for it. I mean, the last 5 days in mortgage-backed securities, we've seen a 250 basis points drop, which is huge. Today was our first plus day in what, 3 weeks?
Been a while. So let's talk about international news. So this is like one of those where I go down to what should be on your mind. So I'm having conversations with you because we notice anything that happens on an international level, our gas prices go up.
Yeah.
And there's really just no reason for it, but it just does. But how does international news impact mortgage rates and impact what we're doing? Because I'm just going to have conversations with people. What happens to the housing market? What happens to interest rates if we wake up tomorrow and Russia's invaded Ukraine?
So these times are strange right now. Typically, international news and national news together. If something spooks investors look to move their money to safer places because they're all about hanging on to what they have rather than losing it all. Because the stock market is high risk, right? So they move to bonds and securities. What I was talking about earlier is how a lot of people watch the 10-year treasury bond to see what mortgage rates are doing. However, they don't tie into each other, but they work off of the same kind of stuff. So if an investor it gets spooked, what they typically do is they take their money out of the stock market and they throw it into securities or bonds because it's secure. Bonds are backed by the government, and securities are safe as well. So as they pump their money into those things, the prices tend to drop. So interest rates tend to drop. As they pull their money out of those, then you tend to see interest rates go up.
So I'm pulling for Russia to invade Ukraine, is what you're saying? If I miss my lock?
If you're talking about interest rates, yes. Like when COVID happened, there was so much uncertainty. That was the craziest time I've ever seen. Rates just fell out. I feel like we went from high 3s, low 4s to in the 2s overnight, and then it was actually this nuts. Throughout the day, the news throughout the day just either being super good news or bad news. You would see rates go from 2% to 5% to 2%, and this is real. This actually happened. You talk to somebody on the phone in the morning and the rate was 2.75 and they're thinking about it. I'm like, what? They call back in the afternoon, it's 5%.
And I love presidential elections because everybody thinks if the other party wins that the world's gonna go to hell in a handbasket and so forth. But it's able just to have conversations about them and explain that, listen, I have not seen a presidential election really negatively have that kind of dramatic impact on the market, but everybody thinks so. So you have a deeper conversation with them. And that's really the goal of this. I'm not an expert on this stuff. I'm not an economist on it, but I can have conversations to get you interested. You talk about, I don't know how many agents are out there having conversations with clients about, hey, what do you think is going to happen to the real estate market if Russia does invade Ukraine? Me personally, I don't think it's going to impact it at all, but it's a conversation.
Yeah, and you're allowed to have your opinion too.
So
it's nice to.
So what are some other, whether international or local news stories that we might want to be keeping our eye out on that could impact something?
I mean, big stuff. Stock market plays a role in ours because obviously when people pull out. So this is something that I talk about on regularly with agents is, stock market. Where do you have your investments? Stock market's been dropping, and typically when the stock market drops, mortgage rates get better. That's a typical market, but not right now. Stock market's been going down, and yesterday was a good day, but rates are still going up. So
it just seems like there's this crazy underlying pressure on everything. Right, usually when home prices go up, rental prices go down. But literally everything is going up right now, and it is largely part due to inflation and our super low unemployment for those that are actually trying to work. Now, the people that are still suckling at the teat of, the COVID dollars, those aren't the rule. Those are the exceptions, right? So, and even then, that's going to be cut off here before you know it. And then those people that are ready, willing and able, people to work they're gonna join the workforce, and then it's gonna be.
What's crazy is the workforce needs it right
Yeah,
now
we
too,
need
right?
it, but I mean, like, that might hurt, you know what I
It
mean?
could.
Because now all of a sudden, we have this influx of labor, this influx of professionals that are like, okay, I'm ready to get off my ass now, right? And then, all right, well, we're not hiring anymore because we already have enough of those people, and then all of a sudden, that's, it comes back to balance.
But hopefully what it's supposed to do is hopefully it makes labor cheaper. It makes products cheaper because we're able to make them faster and have more people that make them. That's what it's supposed to do. And hopefully that's what happens, because we saw, you know, with a supply problem during COVID, we still haven't caught up from it.
Right.
And so we've seen
All right,
things there.
so last question, where do we go? Keep our eye on rates to kind of monitor this. And what's the difference between here's the rate and the APR rate?
Okay,
Because that's my favorite conversation. Well, I was on Facebook and I can still get a 1.75% rate, you know, and I'm like,
I love that.
what's the fine print here?
I think during the Super Bowl, I saw an ad that said interest rates are like 1.99. I was laughing about that. It's crazy what they get away with out there. But to see exactly what the interest rates are, that's tough, because each bank messes with their margins all the time to try to build business, just like the world does with interest rates, right? So we'll cut margins if we need to pick up business, and we'll raise margins if we need to slow down. That's just the way it is. And basically that has a direct impact on interest rates. We tend to keep things as low as possible all the time, just because we kind of have that like Walmart mentality where we're trying to do as much business and win as much customers as we can. But what I would suggest to you is watch the 10-year treasury bond. It's the easiest thing to get to. CNBC is the first thing. If you Google 10-year treasury bond, CNBC is the first one that comes up. It's a very easy graph to look at. Now, mortgage rates are different than treasury rates, but they tend to run right in line with each other. Only weird parts of the market, they do not run in line with each other. And when I say weird parts of the market, I'm talking about like COVID, some crazy, if Russia were to attack Ukraine, we may see them kind of cross each other, but it's not for very long. If you watch the 10-year treasury bond, you're gonna see if it goes up, rates are going up. If it goes down, rates are going down. It's a good place to watch it. As far as APR and interest rates, and APR is a calculation of closing costs and the interest rate together. It gives you an annual percentage rate based on the cost of the closing. So obviously an interest rate is a cost. So you're just building it into the calculation, and that's where you get your APR. So the higher the APR from the interest rate, the higher the closing cost is. Very easy to kind of, if you put two closing disclosures back to back, you don't even have to look at the closing costs if you look at the APR. If you look at the APR and one APR, if they're the exact same interest rate and one APR is higher, we have more closing costs on the other one. The one with the lower APR is better product.
I don't think I ever knew that.
Yeah, yeah.
Me neither, don't worry.